Hi, this is Mark Chandik, and welcome to another episode of Prosperity Perspective. This week, we'll be talking about the second chapter of my book, 10 Financial Strategies for the Smart Investor. Don't try to beat the market. In this video, we'll explore passive versus active investment approaches, how asset allocation works, learning to love the plateau and comparison, and finally, market timing and 2 buckets of money strategy. Hey, listen, we live in a competitive world. Who doesn't want to be the best at whatever you do and expect the best possible outcome? That mentality is true in the investment world as well. Why shouldn't my portfolio beat the market in general? In order to answer that question, you have to first understand what the market is. What are you comparing against? In this context, let's talk about the Standard & Poor's 500 stock index. This widely quoted index represents 500 of the most well-known companies in the United States. Most of these companies do business abroad and represent the latest and greatest thinking and innovation of our time. This is the market. One possible investment strategy is to purchase the S&P 500 index, and your results will mirror how these 500 companies do on an aggregate basis. This approach is considered to be passive. In other words, we are letting the long-term market forces benefit us in our portfolio. Let's face it, historically speaking, this index has done extraordinarily well by most comparisons. In contrast, if my goal is to beat the market and this index, then I'm going to have to do some homework. I'm going to have to do research and pore through quarterly reports of companies to find information that's not already known in the public. Investment managers that do this are said to be active managers. Active managers believe that markets are not inherently efficient and all information is not already known. Through research and poring through these quarterly company reports, they gain special insight into companies and markets. In contrast, a passive approach assumes that all important information is already known in the market and is already priced in. You may have heard the terms alpha and beta in the investment world. Beta is the mathematical term to describe market returns. In other words, passive returns. Alpha is defined as the amount of return above beta that an active approach might yield. Many investors believe that they'll be able to experience alpha quite easily and consistently, but the facts reflect otherwise. According to Morningstar, a well-known investment research company, they reported that fewer than 1 out of 100 managers actually beat the market 5 years running. In fact, a 2014 article in the New York Times suggests the figures are even worse. Out of almost 3,000 mutual funds, the top 25% performers were tracked. And how many of these funds remained in the top quartile for the next 4 consecutive years? A total of 2. That means that 0.07% succeeded and 99.93% of them failed to beat the index. Even with these profound findings, people still seek out and pay high fees for active management, hoping to beat the market. The boring truth is that passive investing actually works in the long run. Put your money in a well-diversified strategy and let it grow. Warren Buffett once said, put 60% in the Standard & Poor's 500 index and 40% in a bond index. Go away for 20 years and you'll do very well. I had 2 clients come in, husband and wife, both have IRAs. They've invested the same amount of money. Many times the results are very, very different. I find that one person has left the portfolio alone and over 20 years they've done quite well. The other person has bought and sold, taken hunches over time, and their account may be as much as 50% less due to taxes and expenses. A larger factor to someone's success is their allocation across different asset classes. Studies have shown that neither individual stock or bond selection or market timing has any appreciable effect over time. With all this information, why do people continue to invest in this manner? Why do they try to hit a home run when they only need singles and doubles to reach their financial goals? One possible answer is that people love to take action, and they hate passivity. Sometimes the best course of action is to take no action at all. People hate plateaus. If their investments are at a standstill, they might feel like they have to do something, take some sort of action, when the wise and disciplined thing, again, is to do nothing at all. Our culture is a culture of immediate results, and we don't have patience. A great example is in a workout program. You begin a workout program and you see profound immediate results, and inevitably you plateau. And this is where most people quit. The truth is that if they had patiently waited through the plateau and given their body time to adjust, they would have gone to a new level of results. But people don't give it enough time. Another bad habit of trying to beat the market is comparing your results to your friends. You may be out on the golf course and you ask your buddy how their investments are doing, and they give you a number, and that number may be higher than your number, but they don't give you a context for that number. They don't tell you how much risk was involved in achieving that number. They don't tell you about the losses they have suffered in other accounts. You just hear the number. They may brag about a particular stock or investment that was a huge winner. You want to win as well, and you may be currently in a plateau, so might think to yourself, let's take a different tack and buy that investment. Unfortunately, by the time they give you the tip, the opportunity is gone and you're stuck playing catch up. The last concept I want to talk about regarding beating the market is the concept of market timing. Market timing means that you will make a decision on your investments based on the news of the day. You're going to try to get out of the market at the height and back in at the bottom. Unfortunately, no one has proven this to work over the long term. I tend to think about the guy at the table in Las Vegas. He's racked up winnings and should walk away, but he doesn't. Instead, he watches his winnings go south. It's very difficult, if not impossible, to determine the point at which you should get out of a market and then get back in. There are no clear signs except in hindsight. The better approach, no matter how frustrating it may be, is to let the long-term returns of the market come to you. Many people confuse market volatility with loss. Market volatility is simply the ups and downs of a normal and healthy market. An actual loss is when you prematurely sell an investment and book a loss. If the idea of beating the market is important to you, then I would suggest you create two pots of money. One pot will be the boring pot. That'll be appropriately allocated across the market, and your goal will be to earn market returns. The other pot of money will be your play money. You're free to buy and sell, take hunches, implement tips from friends, but the amount of money in this pot needs to be one which, if you lost everything, it wouldn't impact your financial security. This would be an interesting exercise to compare the results and the amount for each approach over a 5 to 10 year period, net of fees and expenses, of course. In conclusion, most people don't need to hit a home run in their investments to hit their financial goals. They simply need to earn market returns and avoid large losses. It's not that tough to do, but you need to be focused and disciplined in your approach. Some people have the discipline to do it on their own, and others don't. If you don't, I'd recommend hiring a Copilot, someone who can help talk through investment decisions, especially when emotions are running high. Financial advisors don't earn their money during great times, in a matter of speaking. They earn it during the tough times when you want to sell and get out of a market because of a plateau or you've lost sight of your goals. I hope you've enjoyed this episode. Please comment down below and hit the like and subscribe button so you don't miss out on our future videos. To receive a free copy of my book, 10 Financial Strategies for the Smart Investor, also please click the link in the video description below. I'm Mark Chandik, and thank you for watching.